Hi everyone, welcome back to the audit and attestation class of assessing the risk and developing plan response to those assessed risks. So in this class, we'll be understanding how to use the work of other independent auditor. So let's dive into for more detail. So now we are jumping into the new topic, which is 3.7. That is planning for using the work of other. In this, we'll be learning the planning to use the work of other independent auditor, like your component auditor, joint auditor, right? We'll be understanding the how we can use the work of specialist, how we can engage the specialist to work with us or with the management, right? And the third one is like work of internal auditor. So these are the main three things we'll be learning. First one is work of other independent auditor, which is like your component auditor, which we have discussed just before in the materiality concept as well, when we have like different components. So those component auditor need to perform certain procedure. It can be your network firm or the non-network firm as well, right? So there are certain expectations, you need to communicate them on time. There are certain deliverables they need to communicate to you on time, so that like you can make a timely decision if there is any change in the overall audit strategy required, if there is any change in the risk assessment required, or if there is change in the financial statement is being required, right? So let's jump into the first one, 3.7.1, work of the other independent auditor. So group auditor should consider sufficiency of the group engagement team involvement in the performance of audit, including the involvement of the work of component auditor. So like in last class we discussed, we will identify the scope of work. Like some of the component will be doing full scope audit, some of the component auditor will be doing review only, some of the component auditor will be doing agreed upon procedure, right? This is what it means. Like you as a group auditor need to decide the involvement of the respective component auditor for the respective components or for the respective engagement, right? Just remember the last example which we have discussed, in which we have 83 entities. We discussed like 3 are the main entity for which you require like main full scope audit, and then for 7 of the entities you require the review engagement, and for some of the entities you require like agreed upon procedure, and some of the entity you are leaving a part which is not material at the consolidated financial statement. So this all professional judgment you will be making if you are a group auditor, right? Makes sense? So far so good? Yes, no?
Yes, sir. Yes.
Okay, so in group audit report, when you are issuing group audit report, that means when you are issuing consolidated financial statement report, right? Two things could be possible. One, you can refer to the component auditor report, or you may not be referring the component auditor report. Same way, like earlier, I know like in couple of classes back, we discussed about specialist, reference of specialist in audit report or not reference of the specialist in the audit report, right? When you are not referring component auditor in the audit report, that means you are assuming the responsibility, right? If you look at right hand side, responsibility assumed by the group auditor when component team audit performed by the same network firm. So that means, for example, you are, let's say, any big four company. For example, let's say EY, you have taken a group assignment for a company like General Motors, right? In that, keep the same example in mind, for 3 main scope audit and then 17 other audit. For 20 companies, you are performing the audit, and for rest of the 12 entities, the other local auditors are performing the audit. So in those 20 entities for which like EY and their network firm is performing the audit, you can easily take the responsibility of them, right? Because that is in your same network firm, and you can assume their responsibility. You are not required to give their name for the respective audit. But if 12 are the local auditor for which you are not comfortable assuming the responsibility, like in that case of scenario, you will say for this entity, these auditor has performed the audit and we are relying on their report. In that case, you will giving the reference of the component audit report in your consolidated financial statement audit report, that is in your group audit report. So responsibility is delegated. Left hand side, if you see in the box, responsibility delegated and not assumed by the group auditor when component audit not performed by the same network, right? Because you do not have control on them, right? And you cannot do close monitoring for them. And they are not responsible to reporting to you. They are responsible to reporting to their respective management. So in that case of scenario, you are not assuming their responsibility, and in your consolidated financial statement report, audit report of your group, you will be giving them the reference of their respective financial, respective company and the respective auditor, and you will say we are relying on their report. Right?
And so this is like a mandatory disclosure, right? That
yes,
we will have.
yes,
Okay.
in the reporting requirement. Yes. Right. And if you can do supervision, and if you can do monitoring, and if you can participate in their discussion, then you can assume the responsibility. But generally, like company do not do, like CPA firm do not do. And like because local CPA also, they do not prefer like any third party intervene in their professional judgments when they are conducting the local audit. So practically, it's being like not assuming the responsibility, but theoretically you can if you do the supervision and involvement in throughout the audit of those components. Right? Make sense?
Yes, sir.
Yes.
Factor. Yes, you're saying something. Kush, you're saying something.
No. I just said yes. As a reply to it. Yeah.
Factor to determine whether to make reference to the component auditor in group audit report. First one is like difference financial reporting framework of component and group financial statement. So there might be possibility that group audit which you are doing, they are maintaining their accounts or they are making their financial statement as per US GAAP, and they are making consolidated financial statement as well as per US GAAP. But there might be some component which are in Europe, Australia, New Zealand, Middle East, right? They might be using IFRS financial statement. So in that case of scenario, there's a GAAP difference, right? You cannot assume the responsibility completely because they have audited IFRS financial statement and you are supposed to audit US GAAP financial statement. And the reconciliation between IFRS and US GAAP need to be made. So in that case of scenario, you cannot you can give like reference to the component auditor report which is being made on IFRS, and then you can say the reconciliation is either tested by management, or if you are testing the reconciliation, then you are assuming the responsibility, right? When you are not testing the reconciliation, then you are not assuming the responsibility, but when you are testing the reconciliation, you are assuming the responsibility. Second possible case, when you make reference to the component auditor report in the group audit report, is when group financial statement auditor is taking responsibility to convert component financial statement to group financial statement. That means I am doing audit as per US GAAP, and one of my component, let's say in Middle East, they have made the financial statement in IFRS, and the component auditor has audited in IFRS financial statement, and I am taking the responsibility. Group financial statement auditor is taking the responsibility to convert the component financial statement to group financial statement. That means I am taking the responsibility for testing the conversion from IFRS to US GAAP. So in that case of scenario also, I'll be making a reference to the component auditor that he or she has conducted the audit as per IFRS, and we have tested the reconciliation or we have tested the conversion.
So one question. So this basically conversion of the local GAAP to IFRS. So
IFRS
this kind of service will come under compilation basically, or additional service basically.
This come in advisory. Yes.
Additional service, now?
Yes. Absolutely. Non-audit service, you can say so. Third point is component audit team has performed the audit to meet relevant requirement of GAAS. So here the component audit team, that means the local team who has audited the IFRS financial statement, and they have tested the reconciliation and conversion from IFRS to USD. Then also you can give the reference to the component audit team. Fourth is any additional audit procedure were performed by component auditor to meet the relevant requirement of GAAS. Right? In this case of scenario, you can give the reference of the component auditor report. Look at the note. If A and A to D above, which is mentioned, support by component, then auditor may not make reference. If not, then auditor prefer to make reference to delegate the responsibility. If component team is taking the responsibility and they are reporting to you that we have tested, and they are reporting to you that we have tested all this reconciliation, all this conversion, all the additional entry, then it's your professional judgment whether you want to still make the reference, but generally you will not make the reference. But if they are not taking the responsibility, then you will definitely making the reference. Make sense? Make sense? Any doubt here?
No, sir.
Okay. So now coming to the group scoping. So we were discussing like revenue, expenditure, assets, liability. Keep that example in your mind, and then let's try and understand group scoping. How we do group scoping, like how we identified any, you can say, component required to be full scope audit, how we identify any component for review or engagement, how we identify any engagement for agreed upon procedure, how we identify an engagement as immaterial to the group financial statement, right? So here we'll be learning that, for which like example we have taken earlier. So group team determine the type of work to be performed on financial information of component. Full scope audit, for which entity you will be considering full scope audit, when first by size. That means if any component have more than 15% of revenue, 15% of total assets, 15% of total liability, or 15% of equity, then based on your professional judgment, you can consider that component into the full scope audit. Make sense? Any component which is more than 15% of the group financial statement, you need to consider that component for the full scope audit by size. Right? Second is by risk. For example, in you are making any merger or acquisition, maybe at beginning you may not have those entity in your full scope audit, but let's say close to year end you are getting into a merger or acquisition, so you need to consider those entity into full scope. Or maybe any strategic investment you're making, like today it is not like, for example, when we were doing the audit of GM, so General Motors has opened a subsidiary to make this what you call driverless car, right? That's a strategic investment that GM has made. The name of that entity is Cruise, right? So as of now, even though the balance were very small, but the risk is very high because of the regulatory environment in USA for the driverless car, and the, you can say, innovation and R&D they are doing may result into significant in future. And later on, like, you know, future of the automobile industry is EV vehicle and the driverless car. That is the future of the automobile industry. So strategically, that is very small at this point of time, but maybe once it pick up in 2-3 years, it may be the major part of the organization, right? So those kind of entity can be considered in full scope on a risk based. Make sense?
Sir, when we say significant by size greater than 15%, it can be more or less
more
as
than
well,
15%.
right? So I'm saying, so let's say if the business is very much disaggregated, okay, so let's say if it's an FMCG client which has 50 entities, but all of those entities are very much disaggregated. So the contribution is very small, but at an aggregate level, they're making up 100%.
Yeah, so
and
at aggregate level, you need to make sure you have at least more than 70% coverage from full scope.
Okay, so more than 70% from full scope entities.
Full scope.
So in that case, we can reduce this 15% threshold to, let's say, 10% or 8% to make sure that I am getting full scope entities in,
yes,
right?
Yeah, that's a professional judgment. Yeah.
Right. Okay.
And 70%, what I'm saying, is also a professional judgment. It's nowhere written anywhere in audit guide, but as a professional judgment based on my experience with the PCOB, dealing with PCOB and other reviewers.
And this 15% threshold is the AICPA guidance.
Yes, yes.
Okay.
Right. Next is specific scope. Specific scope are those component which is neither material by size or nor so material by risk. However, to gain appropriate coverage at the respective financial statement line item and disclosure at group level. Select key account or disclosure to test or take coverage on those accounts at group wide level and centralized procedure. So like we were discussing, there might be some component, right, in which like cash balance is high, right? In some component, AR balance is high. Some component may have litigations, claims, or assessment. Some component may have like good revenue, but other things are not so good, right? So in those cases, on those kind of component, you will consider specific scope audit, or you can say agreed upon procedure or examination procedure. Next is specified procedure or agreed upon procedure to test some account balance and disclosure assertion like inventory count, cash count, cutoff. For example, at a consolidated financial statement level, you have like existence issue of inventory or cash balance. Then probably to all those components which you have ignored, maybe you can ask the respective component team to do the cash count at the year end, to do the inventory count at the year end, or to take the bank confirmation. These kind of procedure you can ask for them if relating to those specific assertion which you consider as risk of material misstatement is high. Fourth is review scope. Review scope, the entities which are not material individually but in aggregate. It may close to material, right? So like we were discussed earlier, there are 4 buckets. First bucket is like more than 15%. That is a full scope audit, right? Second bucket, which you can easily ignore, that in total combined together, they are not material to the consolidated financial statement. So first and last is very easy to identify, right? So always difficult in middle, right? To which component I'll assign review engagement and to which component I'll go with a specific scope or agreed upon procedure, right? So here, you need to bifurcate those two further. So for agreed upon procedure, first you identify the entities in which specific accounts balance are material, but not the overall financial statement is material, right? So segregate them to the specific scope or agreed upon procedure. Then remaining, you can keep it for the review engagement. Make sense?
Yes, sir.
Right?
So sir, like we did an example जहाँ पे 125 एक entity का था and like startup वाला basically अगर उनको हम subsidiaries assume करें, so जिसमें मेरे 3 थे revenue, operating expense.
No. Keep other example in mind for 83 entities which we discussed. So first, what we did, 3 entities which were having more than 15%. So we consider them as full scope, right? And then those almost 50 entities which is less than 5% of consolidated, we throw them out, right? So this is clear full scope and no scope. Now come to the review and specific scope, right? For the first, we will look at those entity in which specific account balance are material, but overall that entity is not material. So to them, we will assign specific scope.
So like PM वाला thing, basically like I was saying कि मतलब PM में जैसे हमने middle में देखा था, mid list company में, तो उसमें PMs हमारे 3 में आ रहा था, जिसमें 8.5 का हमने देखा था total materiality का difference आ रहा था.
Don't go into that example. That is for materiality calculation.
तो इनमें फिर हम account level में materiality check करेंगे, मतलब कि क्या check करेंगे?
Yes. Account level. Yes. Whether
तो account level में जिनमें materiality है, उसमें हम agreed upon procedure specific करेंगे.
Yes.
Okay.
Yes. And then like remaining overall financial statement, we'll do the review procedure.
Review procedure. Okay.
Right. That's how like scope allocation is being done for the group audit. right? Now coming to
Clear,
the risk assessment process. Risk assessment process required by group audit team for the component. How you will do the risk assessment? Inquiry. First thing is inquiry with the management and inquiry with the component auditor of the business activity and significance of the group. Second is discussing with the component auditor about the suspectability of the component to material misstatement of the financial statement. Third is review the component auditor documentation of identifying the risk and the procedure they have planned and conclusion they have reached. When significant risk is identified in a component, for example, in any component, you have identified, let's say, litigation claim and assessment as a significant risk. Like, for example, in case of General Motors, right? So they have closed their business in India back in 2017. And they are getting lot of warranty claims in 2017-18. Right? Because everyone is in a fear. Like, if I do not claim warranty now, then like my vehicle is go for a toast, right? It's generally a like human tendency and fear, right? Yes or no? Are you guys with me? Or you are still in a lunch break? Right? So in that case of scenario, we consider that Indian entity, even though we close the business, we consider that entity litigation claims and warranty claims as a risk-based approach, right? So when significant risk is identified in a component which is material to the group financial statement, then group audit team determine the appropriateness of further audit procedure. So we have determined the additional audit procedure to be performed for the warranty claims as well as provision for the warranty. Group audit team should review the procedure plan, perform, and conclusion reached by the respective component team. Like EY India team was doing the audit of GM India, but as a group, we were understanding what all procedures they have planned and what all procedures they have performed and conclusion they have reached. Right? Make sense? Okay, so quick refresher for materiality at group level. I know we have discussed a bit in material.
One question. Risk assessment for the component is actually performed by the group team, right? Group team communicate करती है that these are the risks.
Yes. But we will do the inquiry with the management and we will do the inquiry with the component auditor as well before finalizing the risk assessment.
Yeah. Okay.
Good. So now the same concept which you have studied in materiality, quick refresher over here, materiality for group audit, because like this entire section is for group audit. So we have kept like materiality concept also here. So first you need to calculate group materiality, right? And at the same time, you need to calculate the component materiality as well, right? For calculation of group materiality, you will be consider earning based, activity based, or asset based, whatever is being the focus area of the user of financial statement. Right? First, you need to calculate group materiality, overall materiality, performance materiality, and tolerable error, all the three. Right? Then you are allocating the materiality to the component based on the volume and risk, you can say size and the risk of the respective component. So if you look at right hand side box, which is component materiality is calculated for a group consolidation purpose. And how do you calculate? Is a percentage of group overall materiality based on the size of the component, like revenue, asset, liability, equity, or expense, or risk of the component. So to calculate the materiality of the component, you consider the size and risk of the component. Make sense? Yes? No?
Yes, sir.
Right? And there is also group audit guidance you can see in AICPA website if you want to go more in detail. So there is like guidance on group audit. So that's a altogether separate guidance in which they have given a guidance. Like for example, if your component is 10 to 15% of the group, then you can consider 20 to 25% of group materiality as a component materiality. If your component is around like 15 to 25%, then this percentage, this percentage. So they have shared some guidelines as well. But again, selecting those guidelines is completely professional judgment of the CPA, right? Make sense? Because at the end, CPA is signing the balance sheet. He is ultimate responsible. So he can take his or her professional judgment. Make sense? फंसेगा तो कौन?
Yeah.
Right? फंसेगा तो कौन? No response. आयुष जैन और निमिषा और राहुल.
फंसेगा वही जिसका लाइसेंस लगा हुआ है और जिसमें साइन.
So जिसको डर होता है PCOB का, will take all due care.
Sir, a quick question. This component materiality which is getting allocated, it will be allocated to all the 32 components in the example we talked about, or only
respective each component.
Whether it is audited within the same unit or by the same network firm, or it is done by anybody else, it doesn't matter.
Yes, absolutely true. Look at the note. Component materiality will be lower than group materiality, right? This is a thumb rule because you cannot allocate more than group materiality because no component would be more than 100%. In order to reduce the risk that aggregate of detected and uncorrected misstatement in a group financial statement exceed the materiality for the group financial statement level as a whole, right? Now coming to the documentation, work not documented.
Not done.
Done, yeah. You got it. Documentation of a component team for significant risk. Documentation of component team for a significant risk. Look at component team. What all documentation a component team need to do for the area identified as a significant risk of material misstatement at the group financial statement level. Like for example, we were discussing earlier example of GM, right? We consider warranty as a significant risk area for the Indian entity. We consider litigation claim and assessment as a significant risk area. So in Indian entity, the auditor of Indian entity will give due care and ensure the documentation of following of those significant risk areas. First is group engagement team assess the adequacy and appropriateness of the audit evidence, part of the audit documentation of component team, so we can review their work. Second is if the group audit team conclude that the work of a component is insufficient, and if you are not comfortable with the work performed by the component auditor, the group engagement team should determine the additional procedure to be performed. So we can request them to perform additional procedure to give us a more comfort on those risky areas. Make sense?
Yes, sir.
Yes, sir.
Next is review engagement. So earlier we were discussing on full scope audit engagement. Now review engagement. So in the review engagement, read the report of other component, their review reports, consider the impact of any modification on the report. So when you have assigned any engagement as a review engagement to the component, in review engagement, what component auditor will be doing? Inquiry and analytical procedure only, right? They will not doing test of detail, they will not doing test of control, right? That is what comes in review engagement. Are you with me?
Yes, sir.
Right?
Yes, sir.
And in that case of scenario, you will be looking at their review report. If there is any qualification or modification in the review report, then you need to consider whether those qualification or modification is material to the group financial statement or not. If it is material, then probably you need to consider for the group level. Third is attestation engagement, or you can say specified procedure engagement. If assuming the responsibility, if you are assuming the responsibility, that means you are given the work specific audit procedure or agreed upon procedure to the network firm and you are assuming the responsibility, right? Then evaluate whether the work of other component is adequate or not. Second, if you are not assuming the responsibility, then make the reference in your audit report for that particular auditor, right? Make sense? These all things you need to document in group audit documentation file. So far, so good?
Yes.
So we are done with group audit. Let's do some examples, practical questions. Can anyone read this question for me?
Can I read, sir?
Yeah, go ahead.
If the component auditor does not meet the independent independence requirements that are appropriate to a group audit. I'm sorry for the disturbance, sir, in my talk.
No problem.
That are appropriate to a group audit of a non-public entity's financial statements, that the group engagement team should initially communicate the lack of independence to the appropriate regulatory authority, disclose the lack of independence to the non-issuer's management and consider revising the audit report, attempt to obtain sufficient appropriate audit evidence relating to the financial information of the component without making reference to or using the work of the component auditor, withdraw from the engagement when permissible under law or regulation.
Yeah. So what is the call of the question here? If component auditor does not meet the independence requirement, that means you are group auditor, right? And there are, let's say, 50 component auditor. And one of the component auditor is not meeting the independence requirement. So what you will do as a group auditor? Why so pin drop silence? Will you communicate the lack of independence to regulatory authority? Like, will you communicate to any?
Sir, I thought we should qualify it. No? Like we were discussing when we were discussing that chart where there were many group entities. If audit is not being done for a particular entity, or someone asked a question, so we said no, we can qualify that because obviously audit has to be done. We cannot rely. Or am I wrongly connecting it?
No, I don't think so. We have discussed this point anywhere yet.
So जब हम वो कर रहे थे chart discuss पूरा जिसमें they were main A, B and C were the main entities, and then there were 7 entities which we were.
But we have not discussed any independence point over there.
No, someone asked a question like, okay.
What was the question? Sorry.
Question was particularly कि अगर कोई particular entity है जिसका audit ही नहीं हो रहा है, तो उसके इसमें मतलब मैं लिंक कर रहा हूँ कि independence exactly नहीं पूछा था, but the thing was कि अगर वो audit है ही नहीं, हुआ ही नहीं उस entity का, तो obviously वो हमारे scope में है because we are responsible for audit of a group. So we can qualify that because we do not have anything to rely upon because the audit has not been conducted. And similarly, I was relating if the component auditor is not independent, then we should qualify the opinion because we do not know, or we will get into those details and audit the same again.
Okay, I'll respond to your query. So first thing, like just go back here. Yeah, so we have 4 categories, right? One is full scope audit.
Yeah.
Second is out of scope, which is like easy category, right?
Yes, right.
Then you have review engagement, and then you have specific scope or specified procedures.
Yes.
Right. So here, for example, you are saying out of scope entity for which no audit is required. Then in that case of scenario, we should not be worried at all.
Right.
Right. For full scope, audit is required, right? And the auditor independence is also required.
Yes.
Right. Now coming, let's say out of and let's say for review engagement, review is required and auditor independence is also required. And for specified procedure is also independence is required. Right. If you see, ideally for full scope engagement, review engagement, or specified scope engagement, the auditor should be independent. Right.
Yes.
So here, like if you look at our chart, 3 entities were in full scope.
Yes.
Right. And after that, there were like how many entities were in review? 7?
7 entities. Yes.
Yes.
7 entities were in review engagement. Then I think 20 were in specified procedure.
23
was in specified procedure, and rest of the 50 are out of scope. Right. In those 23 entities, there is one auditor who is not independent. And that auditor, you have assigned the work to perform, let's say, inventory count, cash count, or maybe any other audit procedure, specified audit procedure. But that auditor is not independent. That come to your attention. So what you will do now?
So we will be reviewing the same because we were already doing it. Even if the auditor was not independent, we were doing the specific review of that particular component.
No. We were relying on the report of that auditor, that he has conducted this specified procedure for the group financial statement. But now, if he or she is not independent, then we will perform that work.
So then we as a group auditor will perform the testing.
Yeah, we'll perform the testing and will not rely on them.
But my question was only because like we were relying on his report, like for those.
Ideally, but if he is not independent, then you cannot qualify. You are just not relying on it, and you can perform your work.
Okay.
Right, because at the end you are responsible for consolidated financial statement. If some auditor is not independent out of the group of like 50 companies, then you can just ignore him.
Well, sir, we will qualify when the problem is it's a finding or the manager
qualify. Why do you
No, I'm just saying that this discussion is coming into play because when we're talking about qualification would only come into picture when there is some drawback from the management end or there is something missing in the audit that we are performing, right? But in this case, it's our auditor's independence, like an independent auditor's independence that is in question. So there is no question of qualification in this, is what I'm trying to say.
Yeah, no, good point, Kosh, you bring. Like generally what we have read is qualification is on account of scope limitation, which is GAAS issue or a GAAP issue. Right, but independence, if the auditor is not independent, then he or she is not supposed to perform the audit. But that's also, a preliminary requirement for any assignment as an audit assignment.
Also, this is about the specific procedure. That's why we are not relying. And if there would have been a full scope engagement, then we would have done a qualified opinion.
No, then we will request the management to change the auditor.
Yeah, to change the order, or we will qualify now, basically.
No. Like qualification is not so easy. Yeah, why you are taking it so easy? Like it's not easy. It's a last resort. Generally, we go with qualification, right? First, we try to patch up. First, we try to resolve. When you go for a divorce, and then things are not possible to work out, right? Like in just a one fight, you will not go to the court. I need divorce. No, not at all. Right? First, you try to match up between two of you. Then we try to involve your parents. Then you try to involve their parents. Then to some so on and so forth. Right? Same with the audit. If there is a dispute, there is a possibility, because like in audit, there's always be some or the other disagreement. Right? But all the disagreement may not lead to qualification. So you need to look at the possible solution first, rather than just if the you can say law has given you authority, you cannot abuse it.
Okay.
Right. So like some authority has been given by the law to you as a CPA. It should not mean like all the time you will be dominating to the client. Try to fix the problem. Right. So problem fixing could be you can request them to change the auditor if the auditor is not independent, because if it is a big company which is doing a group audit, that means they may have audit committee. They understand all these requirements for an auditor to be independent. And second thing is, if an auditor is not independent and he or she is accepting an auditing engagement, he is being non-compliant with the AICPA.
AICPA guidelines.
You can complain to the AICPA, they will penalize.
Okay.
Right. So there are so many ways to resolve the things rather than jumping into the conclusion of qualification. तलवार बार-बार निकालने की जरूरत नहीं, दिखा के भी काम चल जाता है.
ठीक है सर.
Yes. Yeah. You're saying something, Rahul or Ayush?
No, sir.
Okay. So now you understood, Ayush. Like, hope I answered to your question.
Yes, sir. Got it.
So now look at those possible this options here. First one is communicate the lack of independence to appropriate regulatory authority. Do we need to go to the tax authority? The answer is no. We'll go to the management at the max, right? Second is disclose the lack of independence to the non-issuer management and consider revising the audit. So you have not issued the report yet. So how do you revise the audit report? So that's also incorrect. First line is correct, you can go to the management, but second line is incorrect, right? Fourth one, withdraw from the engagement when permissible under the law or regulation. For all small thing, you should not be withdrawing from the engagement, right? You're trying to fix the problem. And this is not the very major problem, because like it's a risk on that auditor also who is accepting the audit engagement without independence. So ideally, like this situation is just a theoretical situation, but if anyone take it, then first attempt to obtain the sufficient and appropriate audit evidence relating to the financial information of the component, and without making reference to the work of the component auditor. You can do direct audit of this respective company or respective entity, and you can do the direct review or maybe specified procedure, and you get rid of it. Right? You may at the max you will charge additional fees. That's it.
Okay.
Cool. Question number 2.
Amal, 1 second. Agar we go back to the type of component auditors, तो या तो full scope होगा, specific scope होगा, review scope होगा, या agreed upon procedures होगा. In all these cases, independence तो required होती है, लेकिन if going back to what we studied in the first chapter, तो उसके हिसाब से except for the compilation engagement, हर engagement में independence is mandatory.
Yes.
अगर वो ना हो तो जो हमने फर्स्ट चैप्टर में पढ़ा था उसके हिसाब से तो we withdraw from the engagement if there's no independence.
No, it's not our independence. It's component independence. Like for example, you are doing audit of General Motors in USA, and let's say General Motor Bangladesh, that's a component. And then Bangladesh CPA or chartered accountant, whosoever the local firm, they are not independent for the Bangladesh entity. So you will not be withdrawing it. They need to withdraw it.
Okay, so that was we withdraw जब हम खुद independent नहीं होते.
Obviously, then we cannot accept even. Not on withdrawal, but you cannot accept it at the first stage.
Okay, thanks.
Cool. Second question. What an accountant responsibility for using the work of other accountant in a review of group financial statement performed as per SARS, right? Review, when you are doing review engagement, you are using SARS, right? So here they are talking about review engagement in a group audit. What an accountant responsibility, Hamari responsibility, what is our responsibility when you are giving a review engagement for the group financial statement? First is qualify the review report if the review accountant did not perform procedure for the entire group financial statement. Second is make reference to the work of component accountant in a review report if the component was subject to an audit. There are no special requirement for obtaining information from a component accountant in review of a group financial statement. Read the review audit report of a component accountant considering the impact of the report modification to the group report. Which one is right and why? Do you understand what is the question? In a group audit, you have assigned, like in our example, out of 83 entities, we have given 7 entities the review engagement, right? So what we need to do for those review engagement when we are signing the group financial statement or consolidated financial statement? Look at first one. Do we need to qualify the review report if the review of accountant did not, like if we have not performed the work? Do we need to
not qualify? That's
answer is no, right?
Yes.
Second, do we need to make a reference of the work of component accountant in a review report if the component was subject to audit? If the component was subject to audit, then why we will look at review again? The statement in itself is incorrect.
Yes, right.
Third is there are no special requirement for obtaining information from the component accountant in review. No. As a group audit, we will be asking them to give us their review report, right? Fourth one is the read of review report and consider the impact. This you have already studied. This you have already studied here. Where? In the review engagement. Right? Cool. Last question. I think third is the last question. Yeah, then we jump into the new topic. When the financial statement of the component unit in a group financial statement audit are prepared using applicable financial reporting framework different than the group financial statement reporting framework. That means you are using US GAAP, they are using IFRS, right? Simple. The group audit report may make reference to the component auditor report in which of the following circumstances? When you will be making the reference to the component auditor report when there is a difference in financial statement reporting framework, right? This we have discussed. First one is the group audit report disclose that the group auditor took responsibility for evaluating the adjustment made to convert the component financial statement to the same framework used by the group. That means the component auditor has done the audit of IFRS financial statement, and you have taken that as a base and all the conversion entries you have tested. So in that case of scenario, you can make the reference of the component auditor on which you are relying on their IFRS, which you have considered as a base, and you have tested the conversion entry, right? That you can do. Second is reference to component auditor report is prohibited in this circumstance. So answer is no. In this circumstances, yes, you can give the reference. It's completely professional judgment. Third is the group audit report disclose that the component auditor took responsibility for evaluating the adjustment made to conversion the component financial statement to the same framework used by the group. But if component is taking the responsibility of testing the adjustment entry and conversion entry, and then he is reporting you in a US GAAP, then you are not required to give the reference, right? If they are giving you the report on US GAAP, whether for local purpose, they have done, like for example, like when I was doing audit of Goodyear India Limited, right? So we will be doing their audit as per IndAS, right? Indian Accounting Standard. And every year we do the conversion from IndAS to US GAAP, and we will doing the testing of all those conversion. And then to the US company of Goodyear, we'll be giving them a group report in a US GAAP. So if I am giving them a report on a US GAAP number, then why they need to make the reference of mine? Make sense? Not required?
Yeah, okay.
Understood third point?
Yes, sir.
Fourth point is the component audit report disclose that the component auditor took responsibility for evaluating the adjustment made to convert the component financial statement to the same reporting framework used by. So third and fourth is almost same point.
Yes.
Yeah. So this is what we done with the group.
Sir, one question here. So when we are, taking a decision like whether which accounting standard we will have to follow, whether IFRS or the other one. So, sir, at that particular point, we will have to see now, like what our component auditor is, following and what we are following, so that we are on the same page at the first instance itself.
Yeah, it's a management responsibility. Two primary responsibility of the management. One is selecting the reporting framework and ensuring the fair presentation of the financial statement as per the reporting framework. Second is DIM. What is the full form of DIM?
Designing and implementation of
yes. Design,
measure,
maintenance of internal controls.
Yes,
right?
yes.
So selecting the appropriate framework is the responsibility of management, and they will communicate like this is the reporting framework which we are using and you need to audit for this. Right? Make sense?
Yes, sir.
Yes, sir.